Hi, everyone. We're so happy that you're here today, and we're just getting ready, and we'll start in about 2 minutes, but thanks for coming, and we'll get started. See you in a minute. It looks like someone had a question. Do you want to type it in chat or in the Q&A? Oh, no worries. Start my video. Hi, everyone. Duran, are you here too? It's hard for me to see. I'm going to stop sharing.
I am. Can you hear me?
Hello.
I just can't. You have to make me the host because I can start my video.
Okay, let me make Duran a host, and then I will do a little introduction. And I'm not sure how many folks that are here today were here last week, but this is actually a 3-part series. And so if you weren't able to make it to the last week presentation, I'm going to post the beginning basics of money in the chat because we actually have it saved as a YouTube video. So I'll go ahead and share that, and you guys can watch it on your own time. So anyway, I'm Rachel Schmidt. I'm the Youth Services Program Coordinator here at the Central Park Library in City of Santa Clara. And we are very excited to work with KeyPoint to bring you this awesome financial series. It's a 3-part series, as I said, and we'll have one more next week, and that will be really wrapping everything up. And it'll be at the same time on Wednesday, so 2 p.m. And our awesome speaker today is Duran, and he was here last week, so thanks for coming back. And he's going to talk about understanding credit. So what we'll do is check in throughout the presentation, and I'll monitor the chat for questions, and just go ahead and type your questions in the chat in the Q&A, and we'll get to them as we kind of get through the presentation. Does that work for you? I also wanted to mention that we have a survey at the end, and KeyPoint will be giving a drawing for a $25 Amazon gift card. So make sure you fill out that survey and put in your email address, because that's how we'll know how to contact you. And that will just pop up at the end of the Zoom session. Okay, so I'll just hand it over to Duran, and let me know when you need to check in for questions. Okay, thank you.
Okay, thank you, Rachel. Let me share my screen here. If you can make me a host, please.
Hold on one sec. I thought I did that, but I guess I didn't. So we're having trouble with this stuff today. There we go. Yeah, because to me it says host, but let me unhost you, I guess. Yeah, it says host for me. Hold on. Sorry. Let me try it one more time.
Okay, you made me a host. Let me see. Okay, I can share my screen now. Let me see here. Set up. Wonderful. Can everyone see my screen? Can you see my screen, Rachel?
Yep, looks great.
Great, wonderful. Well, thank you very much for having us today. My name is Doron Neumann, and I'm from KeyPoint Credit Union. And I've been working for KeyPoint Credit Union for the last 17 years and over 25 years in the financial industry. I do have two teenager sons. One is a freshman in college, and the other one is a junior in high school. So I'm familiar with a lot of the ways that teenager or young adult ask about finance, and I also can relate what I teach them and how do we talk about money and so forth. Today, as Rachel mentioned, is the second session of a three-session series. And the first one, we talk about a little bit about what is a financial institution, what are the product services and tools, and really get familiar a little bit about what is financial institution and what the checking account, savings account, and so forth. Today, we're going to talk about, we understand credit. What is credit score? A lot of people ask, you hear a different story about credit score. You have like 800, 500, 700. So we're really going to put it in a frame of what is credit score and why it's important and actually why we talk about credit and so forth. And next week, we're actually going to put everything together and we talk about money management, the whole process. How do you put together budget? How do you look at credit and so forth? And really making sure that you start with a strong foundation for a great financial future. So if you have any questions, please don't hesitate. Just put them in the chat or Q&A and Rachel will read them. There's some section when I ask your response, so you can actually key it in the chat function. So there are a lot of questions about money, credit, and so forth. So don't be ashamed to ask any question because every question is a great question. And if you don't ask it, you wouldn't know. So I would encourage you to ask later any question that you have. I'm going to go a little bit and do some review of what I talk about. If you did not attend the last session, give you a little bit of some idea of what we talk about. So first, I'm going to talk about what is financial institution. And this is very important because this is the key to really understanding a lot of money matters. And so financial institution is organization like a credit union, a bank, when actually it's a licensed organization that regulated by a national government or central bank, and they help people manage their money. They help people, they have license to take deposits, to make loans, and to offer different services, investment services, and so forth. So this is an organization that help people manage their money. They're regulated, they're insured by the government, and you can see a lot, you can you know a lot of them because you see them when you go and travel around. You see banks and credit unions. We're going to go into it. Financial institutions are important to the economy because they provide ability for businesses and consumer to react and consumer to interact by moving money and so forth. If you have to pay bills or you have to send people checks and so forth, those are the institutions help you to conduct those transactions. So it's very important. Also keep your money safe because you don't want to walk with $1,000 in your pocket where you have a place you can actually deposit and you be safe. You don't have to worry about losing your money. So financial institutions, most of you familiar with credit unions. I work for Keypoint Credit Union. There are Mary West, there are Patalco, there are Navy Credit Union, Pentagon Credit Union. There's many credit unions. And credit unions are financial organization that the customer call members, and they're not for profit. They want to make profit, but to have all the money that we make go back to the members in terms of better rates, better product and services, and it's all about our members. And you have to qualify for credit union based upon different categories, some from geographic category. If you live in Santa Clara County, you may be able to join certain credit union. If you work for, let's say, teachers credit union, only teachers can join credit union. So the different categories. Retail banks like Chase, Bank of America, Wells Fargo, those are retail banks. The customer call customers, and they are for profit. So all the profit that go back to people that the shareholders, the people that trade, they have stocks in the banks, and they get the profit from the retail banks. We have commercial banks. Commercial banks are usually organizations that are catering for businesses. So Comerica, Heritage Bank, those are banks that are work only with businesses and they cater to businesses. And they're investment banks, different investment, Fidelity, JP Morgan, and so forth. There's investment banks that they deal with investment. Private banks usually are banks that deal with individual, very affluent individuals that usually have a couple $1 million in accounts, and they need special services. So they private banks work with those individuals. And online banks, you find some organizations that are on specific online. They don't have branches, but it's purely online bank. So and central bank is a bank that, like the Federal Reserve Central Bank, is the bank that regulates all the banks in the country. So there's a different banks that we have, financial institution, and those institutions able to take money and also lend money, give loans to consumers and businesses. So talk about deposit account very quickly. Deposit account is an account that financial institution allow you to safely, easily manage your money. You put your money in, you deposit, you take your money out, you withdraw, but this is an account that you able to manage your money. So the different type of deposit accounts, we talk about checking account, savings account when it help you to grow your money and keep money in the case of emergency, or you want to save for something very special, emergency, you have a savings account. Money market account is another form of savings account that pays a little bit higher interest. And certificate is another form of saving tool account that help you earn more interest, but then you committed your money to the bank for a certain amount of time, something that we talked about last week. And if you go into video that Rachel posted on YouTube, you will see all the information about those accounts. So talk about loan. What is a loan? A loan is extension of credit to a consumer by or business in form of borrow funds. So very simple. A loan is I'm giving you money and expect you to pay me back this money. I'm extending you credit. So people hear a loan, another way of talking about loan is if you hear I say someone, I extend them credit, mean that I give them a loan. This is how much money I give them, and which you will have to pay back with interest to the lender. So if I give you a loan, you will have to pay interest, and interest is the fee that you pay for the loan. So interest is a fee that pay on borrow money. This is what interest is. It's a money is deposited in interest bearing account. Interest is paid to the depositor. So let's say a savings account, you put money in the savings account in the credit union or bank. We will pay you interest because what happened is we borrow money from you. When we borrow money from you, we will pay you interest. It's the fee for us to use your money. On the other hand, if you borrow money from us, you will pay us interest because we lend you money. So interest, again, it's a fee on a borrow funds. Interest, and again, a savings account, as I talk about, when you have a savings account, we pay you interest to the depositor. And when a loan account, we pay the financial institution get paid interest by you. You're the borrower, you pay interest back to the financial institution. And this is the way financial institutions make money, by borrowing money, taking money from you and deposit money, and they pay you certain interest rate, and then they take this money and they lend it to other people, and the difference called margin, the difference, this is usually how financial institutions make money from when they do loans and deposit. So this is a little bit about, we talked some of the things we talked about last week, and I wanted to review them because I think it's very important. So we talk about loans. I think it's very important to understand some of the terms of loan because credit derive from loans. So I'm going to talk about a few terms that I think it's important to understand. Principal is the amount that you borrow. So let's say that I would like to buy a car for $10,000. The principal, mean the base amount, the amount that I receive from the credit union, it's $10,000. It's the principal, it's the base amount. We don't take in any consideration any fees or any interest. It's the principal amount, the base amount that I borrow. I borrow $10,000. It's the principal of the loan. Rate is you hear people say, what is the interest rate on the loan? What is the interest? Rate is calculated as a percentage of the loan. So here 1%, 2%, 3%, mean it's the percent that you take on a principal, and you pay a certain percent of the principal through the term of the loan. This is rate. So interest rate, if we have $10,000 at 1%, it's be 1% of the loan to the term of the loan, the loan amount, to the what's the term going to be, the time period. So we talk about time period. Let's say I take a loan for 60 months or 5 years. Usually we talk about month. So I say for 60 months, I take a $10,000 at the rate of 2%. I will have a payment that it will involve the base, what I'm going to go, money going to go into back in the principal, but also I'm going to pay interest above it. So the rates is spread to the term of the loan. Payment is the amount that you will have to pay back on the loan that you take, and the payment includes usually the principal, whatever the part of the loan, and the interest that you pay. It's combined together. It's going to be the payment. Every month you will have to pay back a payment. You pay back the loan. Fixed rate loan. What is fixed rate loan is, let's say I take a $10,000 loan at 1%. I'll just give example, or 2%. To the term of the loan, the rate will not change. It's always going to be 2%. I mean that this is take the principal, add the 2% will be on the loan, divided it into the term, the 60 months, and this will give me the payment. Now, the different way to calculate, because I'm talking about simple interest loan and compound, but I just want to give you an example of what is payment. Payment include the principal that you pay and the interest. Fixed rate, again, the rate's going to stay the same to the whole time of the loan. Variable rate loan, the rate will change depend on different index, consumer index. There are different indexes that banks and credit unions are using. One of them called LIBOR, the other the Wall Street Journal prime rate, and so forth. So what it is, it's the rate. As the rates in the market changes, the rates on your loan will change. And I know I'm going faster over it because we do have limited time, but I will encourage you to actually start looking and different terminology to really understand what are loans and so forth. Cosigner. Cosigner is someone that co-signed the loan for you, the guarantee. Let's say you're not qualified, you don't have enough ability to get the loan, you will have to have someone that co-signed for you, mean that guarantee that you pay the loan back, and they are responsible for the loan the same as the way you are. It's a cosigner. Simple interest loan is really, it's a loan that you pay the interest only on the principal that left, mean that you pay, let's say you pay $10,000 and your payment every month, let's say is $100. Every month you will pay interest only on the amount that left for the loan. So let's say you did first payment was $110. So the next payment, the interest is going to be calculated not on the $10,000, it'll be calculated really on the $890 that you pay for the loan. Compound interest loan is you pay interest on interest. And I'm not going to go in too much into it. We're not going to cover much today, but it's another way of calculating what interest, what fee you pay for the loan. Payoff is when you totally pay the loan. So let's say you had the loan for 5 years, 60 months, and you had to pay every month, and you paid it well every month, but the end of the last payment, you pay off the loan. I mean, you completed your obligation to pay back the loan, you pay off the loan. Collection is when you don't pay off the loan, and you say you decided, oh, I'm not going to pay it, then any financial institution will have a collection department, and they will try to collect the funds from you because you own the financial institution money. We will try to collect the money from you. It's called collection. Charge off is when you are unable to pay the loan at all. You take a loan for $10,000 and you pay it a little bit, something happened, and suddenly you cannot pay off the loan. Then it will go to charge off, meaning that you were late many times. We will totally write it off. You still be, for us, we will write it off, but you will owe the money to the financial institution. So when you have charge off, sometimes it goes into court and sometimes there's a judgment, but you're not off the hook from paying what you owe the credit union or the bank. Repossession is when you buy a car and you do not pay a car loan, you don't pay the payment on the car. the credit union or the bank will send a service to take your car from you, and it's called repossession. And foreclosure is the same thing. If you buy a house and you do not pay back the loan, then they will take the house from you. Someone take the house from you, it's called foreclosure. So I just want to go a few of these terms because I think it's important to understand when we talk about loans and credit. So the different type of loans, type of secure personal loans. A secure personal loan is a loan that's secure backed by collateral. So home loan, usually called mortgage, is backed by the home. It's secure, it's backed by the home. So the loan is backed by the home. Car loan is backed by the car itself. So I mean that this is a loan, but it's backed by the car. I mean that if you don't pay it, the credit union, the bank can come and take the car and sell it and recoup the money for the loan. Or if you take the house, a foreclosure on the house, they would come take the home, sell it, and try to get the money back that they loaned the person. Motorcycle loan, it's secure loan because there's a collateral. Collateral is the thing that against the loan. So motorcycle, car, or home, an RV loan, and stock secure loan. Sometimes you do loans against stock. So I mean that if you don't pay, we can take the stock. So we have some security against the loan. It's a guarantee against the loan. And certificate of deposit secure loan, I mean you have the money in the credit union, the bank, you borrow against the money that you have, and you pay on the loan. And once you pay the loan, we'll give you back your money. You can use your money. So this is secure personal loans, meaning that they secure against something. We also have unsecured personal loan. There's nothing secure about it. I mean, there's nothing guaranteed. You are the guarantee. So student loans, really, when you take student loan, you are the guarantee. You guarantee that you will pay it back as a student loan. Personal loans, unsecured personal loan, mean that you guarantee saying that I will borrow this money and I promise to pay it back, but there's no guarantee. No one can come and take you. It's your word say that you will pay the loan. Personal line of credit. And let me ask you this question. What type of loan is a credit card? This is a credit card. If you want to key in, Rachel, if you don't mind, just read what they key in. So what is a type of loan is credit card? A secure and unsecure? What most people say?
They said both. Secure. Some people say unsecure.
Right. It is. It's a what is a credit card? It's secure loan or unsecured loan. Credit card is unsecured loan. It's a loan, right? Because you have nothing against it, and there's nothing to secure. If you go and buy groceries with it, it's mean that we give you a loan, but it's not secure by the groceries. It's actually unsecured, mean that you guarantee to pay back this loan at any time that your payment is due. At the end of the month, you will have to pay the payment back. We're not going to come and take your groceries from you as security. So credit card is a loan and it's unsecured loan. But credit card, a lot of people confuse credit card is a loan. And difference between credit card and debit card, and we talked about it a little bit last time. Debit card tied to your checking account, mean that if you don't have money in your checking account, you can't use your debit card because there's no, I mean, it will decline. When you have a credit card, you have a certain amount of credit. Let's say you're able to have, you can charge $1,000. I mean, if you charge it, you don't have the money, you borrow the money from the credit union of the bank, and you're able to use it, but you have to pay it in later time. So credit card is a form of a loan. So I have to put a disclaimer. I'm going to talk about what is credit. Now we covered a little bit of basics of loans, some of terminology. I'm going to start talking about credit. So I just want to put a disclaimer that because sometimes there are adults in my over 18 on my presentation. This is not about repairing your credit. I'm not going to submit any dispute. Sometimes people ask me to submit dispute for them, for the credit bureau. This is for educational purpose only and information only about credit, but it's not, I'm not here to correct, to fix anyone's credit. It's really about explaining people what is credit and how can you establish credit. Okay, so we go to what is credit report. So I'm going to give you a few scenarios. Scenarios one, you go with a friend to a sandwich store and you would like to order a sandwich, your friend order a sandwich, and your friend looking at his wallet, and you can say he can't find any money, doesn't have any money. Yeah, I guess you forget the person forgot the wallet, and they ask you, would you mind lend me some money and pay for my sandwich? I'll promise to return the money to you next week when I see you. You say, no problem. Yeah, it's a good friend. They buy the sandwich, you buy the sandwich for them, and you pay for them. And um, next week they come back and they pay you back. Scenario number two: you go with the same friend to a sandwich store, and they forget the wallet, and they say, oh well, I'm going to I promise to pay you next week. Can you buy the sandwich for me? So you buy the sandwich for them. A week goes by and they don't pay you anything. You see them again. They say, "Oh, don't worry, I'm going to pay you next time." So okay, it's a good friend. So next time you see them, they don't pay you. They say, oh, "I'm not going to pay. No, I don't have money right now. I can't pay you." And so over for about 2 months, they don't pay you back your money. Then you meet them again and you go to the sandwich store again, and they say to you, "Hey, I forgot my wallet again." They have a case of forgetting the wallet. Would you mind buying a sandwich for me? Would you lend them the money for sandwich or not? Put it on your on a chat. Just say yes or no.
I see a lot of no way.
No way. Okay, great. You're not gonna give them money because why? Because they did not pay you before, right? So you know now that this person is not reliable. They're not gonna pay you. They're not gonna pay you. Let's go another scenario. You go to the sandwich store. Now you're three friends going there. And let's refer to scenario number one. You go with the three friends. You go to the sandwich store. The friends that always forget the wallet say, "Hey, I forgot my wallet. Can you buy the sandwich for me?" But this friend did pay you last time. Okay, so let's look at scenario one. He did pay you a week after, and but you don't have money. But the other friends that with you guys, he asked the other friend, "Can you buy from me?" And so the friend say to you, "Did you ever lend the money?" I know it's kind of a little bit confusing. "Can you lend the money?" And you say to him, "Yes, I lend the money," and he pay back. Should the other friends will lend the money to your friends? Just answer in the scenarios. Yes or no? What people say? Would the other friends will once the friends that pay you back the money, should you get the loan from the other friend? So yes, you should get the loan from other friends. The other friends should pay for the sandwich because you gave a reference. You say, yes, this friend did pay me back, and no problem. I can count on him. He always forgets his wallet, but he will pay you back. He's good for his money. Now let's go to scenario number 4. Three friends going again to the sandwich store, and the person that always forget the wallet ask you to buy them a sandwich. You say, I don't have enough money, and they ask the other friend. But in this case, we refer to scenario 2 because this friend never pay you back his money after you lend them. And the other friend say to you, hey, is he good for his money? Would he pay you back? And this time you said to the friend, no, he did not pay me back. I bought a sandwich for him. He never paid me back. So this is what credit about. And this is a scenario about credit. So your friends will not give them the money because he asked you as a reference, did he pay the other friends that always forgets the wallet? Did they pay you back the money? So what is credit report? A credit report is a financial report card with information that determine your ability to repay, borrow money, and your financial credibility. So if you keep it in the very terms, it's a reference. It's let us know, did you pay your responsibility when you borrow money? Did you pay it back? And it's about really, when you go into the credit union, you go to a bank, we don't have any information about you, right? Someone new come in, and you like to borrow money from us, we have no idea. How do we know if to give you money or not give you money? To have credit, you have to be at least 18 years old. So we don't know that about you. So we need to find some resource to know a little bit more about you, more information before we give you money. Would you give anyone money if someone stopped by the street and say, hey, and you don't know them, can you give me $100 today? I promise to return to you, but you don't know them. Would you do it? Probably not. So this is what's credit. Credit is a report that help us to assess your ability to purchase good or service and pay them back. It's all tied back to loans. Remember, we talk about loans. So when you come to ask for a loan, we need to have some reference. The credit union, the banks, we need to have some reference about you. You have to determine your trustworthiness. Are you going to pay your loan back or not? So credit is about really your ability to pay the loan back, and are you trustworthy? Should we give you our money? Your personal credit report it's a report that include your financial account, all your obligation, all the loans that you have, as well as identification information associated with them. So it will give you your social security number, it will have your address, it will have a lot of information, your employer, it will have a lot of information about you. So we can make a determination, should we give you a loan or not? The report is called a credit file or credit history. So we talk about credit report. Some people refer to it as a credit file or credit history. Credit reporting companies collect or organize the credit history from your creditor in a public record. So what happened, there are companies, and we're going to go into it a little bit, that collect the information about you, they put it in all the data together, and actually there's a file. It's a credit file. About every person is a credit file that has the information about your social security, where you live, your address, all the addresses you have, any credit that you take, any loan that you have, any employer that you have, they will have the information in the credit report. Any lien, mean any if you own taxes, if your government has certain claim against your wages and so forth, everything going to be, all this information, data about you is collected in the credit history. So credit report is a report of debt paying history, mean that every time you have a loan, it will record every month, the credit union, financial institution, every payment that you make will report back to the credit bureau, did you pay it or you did not pay it? And all this information is collected into your credit history. So every loan that you have, car loan, student loan for college, credit card, department store loans, mortgage, any loan that you have will be recorded in the credit report. Include how much money you have borrowed, from who you take it, the time of the payment, how much credit available for you, and your credit rating will also determine your credit score. So it will, everything together, you put everything in one formula and I'll go over it in a minute, and it will determine what is your credit score. So all the information that you have, how long there was the loan is for, what is the payment, if it's a $50 payment, did you make it on time, were you late, how long you were late, all this together goes into your credit report. And this is taken from loans and credit bureaus. So the number of credit bureaus that are in the United States, there's Experian, there is Equifax, and there's TransUnion. Those are the three main credit bureaus that collect the information about you. They collect all the information and they give it back to the credit unions or bank. And I'll show you how does it work. So those are the logos of all these three credit bureaus, the companies that collect your information. So what happened is you pay. So let's say you come in, you take a loan, and when you take the loan, you pay the loan. Let's say you pay first month, you pay $50 for your loan. Your loan is, the payment is $50. What happened when you pay this loan? When you take the loan, we say, John just took a loan for $1,000. where his payment is $50 a month. Just give an example. And it's for 24, let's say 24 months alone. And so what happened when you make your first payment, we will report this information to the credit bureau. We say, John paid well the first month. He was on time. He paid $50 and he met his obligation for that month. All this information, lender share information with the credit. So what happened? We take this and we send it to the credit bureau, to the credit bureaus for them to create a report. The credit bureau company share this with your loan lender. So what happened? Let's say that you came to the credit union and you took a loan, let's say a year ago, and you paid well, and we reported to the credit bureau. Now you go to another institution and you say, I would like to issue a credit card. And they have no idea about you. So what they will do, they will contact the credit bureaus, the one of these companies, say, do you have any information? When you have to complete an application, it's a loan application, and the loan application will have a lot of information about you. Ask, where you work, your social security, your date of birth, your name, address, employer, and so forth. Once you complete the information, we process it, and the underwriter is the person that review your loan. The underwriter and the financial institution will look at the information, but they don't have enough credit information about you. They will request a report from the credit bureau about you, and they will put your information, and the credit bureau will send a report about you. And from this report, it will say, and this report will tell us that you borrow $1,000 before and you were able to pay it on a monthly basis. You did well. If we see that you did well, most likely that you will receive a loan or the credit card. But let's say that you didn't do well, you're probably going to decline, mean that they will say, I'm sorry, you're unable to do it, or they will ask for you to have a cosigner, someone that will guarantee for you that you will pay. So this is the cycle of the credit. You take a loan, information reported every month. It's reported to see what is your credit worthiness, mean you paid well, what is the amount of credit you have. And it's a cycle. Every time you come take a loan, you have to apply so people can make a decision upon if to give you a loan or not. I want to stop for a second, and I want to see if there are any questions so far. Rachel, you want to see if there's any question?
Any questions? I don't see any currently. They were just answering sort of your questions, but I don't see any specifics.
Okay.
But you can put them in right now if you have stuff.
Okay.
No? Okay.
No problem. So let's talk about what is credit score. Credit score ranges, there are different models for different companies. So every company takes the information and put it into formula. Most of the formulas are proprietary formulas, secret formulas that they put into it, and they give you the score. Most of the scores run from 300 to 850. TransUnion, which say Trans Risk score, it's from 100 to 900. Vintage score is from 541 to 990. But what it means is that the higher the score, the better your credit. More people will willing to give you money. If you score at 300, no one gonna give you any money. If your score is 850, people will extend credit for you, will let you borrow money. But beside the FICO score or the score, FICO is Fair Isaac company. It's one of the first companies to come up with the formula and as how to calculate the credit score. Equifax uses different parameters, but it's between, again, I would say good credit is 800, 758 and above, and challenge credit is between 500 to 300. Most credit score include the FICO score, the latest version of vintage score. It's different again, formulas work on a certain range, and there are different category between bad and excellent credit. When we make a decision for a loan, we look at the credit score. It's one of the criteria, but the other criteria is that going to make a decision of the loan, like how much money you make, the time that you work, what is your profession. All these things are getting into the, when we qualify for a loan, we look at many factors, but this is one of them. This is one of the main factors that we're looking at. It's the credit score. Excellent credit usually is between 781 to 850. Good credit is 661 to 780. And fair credit is 601 to 660. And poor credit is 501 to 660. So I mean that if you have 501, you probably will not give you a loan. Remember the store, the scenario 2 about the sandwich store, mean that this person probably will have a credit score of 500 if they did not give you back your money for your sandwich. Then they give you the loan. Means that when we look at this loan, when you look at this credit, you know that this person is not trustworthy. I mean, it will not pay back the loan. So most institutions will not lend this person any money. And bad credit below 500 is bad credit. This is how credit score, again, this is what it is. It's a good credit to very good credit. And this is kind of see how people, if people have good credit. And so what happened is usually why it's important to have good credit or good credit history, because your credit is tied to two things. One is if the financial institution will give you money, and also what you be your rate, your interest rate, your fee that you pay for the loan. So let's give you an example. Let's take it's example for the sake of this session. Let's say you have an excellent credit and you would like to take a $10,000 loan, and the rates, the best rates that you can get on that loan is, let's say, 3%. If you have a 800 credit, you're probably going to get the $10,000 at 3%, the best rate, mean that the fee for it is going to be 3%. Let's say that you have 680 average credit. You may get the loan, then decide, okay, I'm going to give you the loan. However, the rates, instead of going to be 3%, it might be 6%. Mean that the rate's going to be much higher. So the better your credit, the less fee interest you pay, because what happened is the less risk for the credit union or the bank to lend you money. Mean that we know that you're a good customer, you're a good member, and you will pay it back. So it is less cost for us, so we can provide you with less interest rate. But if we know that you didn't pay before and your credit is not as great, there might be risk that you will not pay the loan back, so the interest rate is much higher. And if you have 520, you probably will not qualify for any loan. So when people say, well, it's cost you less to have good score, mean that really the fees, the interest rate that you pay on a loan will be much better than you pay when you don't have great credit. And you have more choices, because when good credit, you can get approved anywhere, but when you have credit that there's some challenges, you will probably either not qualify, or you will have to pay higher interest rate. So there's different correlation between the interest rate, the fee that you pay on the loan, between what is your credit score and what is your credit history. This way, people say it's really great to maintain good credit score. This is why it's important, because you'll be able to get a loan at the best rates that the financial institution will offer to you. So credit score determine the FICO score model created by Fair Isaac Corporation in '89. It's called FICO. Sometimes people say, what is your FICO score? And they mean that what is your credit score? Calculated on a number of elements. So this is a breakdown. Again, it's in a way approximate, but this is what the credit bureaus provide as a guide. So 30% of what the score is determined upon is the amount you owe, meaning how much money you owe, how much credit available for you to use. Let's say that you have a loan for $40,000, and then you have a credit card for $20,000, mean that now you have your extended credit of $60,000. And if you pay it well, mean that you have, you get paid, mean that you pay well, you're probably going to get the 30% calculated into the formula of your score. 35% is payment history. This is one of the largest factors. How do you pay your credit? Do you pay your payments on time? When people say always pay your payments in time, it's because this has the largest effect on your credit score. So if you have a loan, what I recommend, so you never forget, just do an automatic payment, mean that you set up automatic payment from your checking account and to the loan, and when it's automatic, it just deduct from your checking account, and you never ever forget about it. If you go on vacation, it's not that you suddenly need to pay. You just set up the payment, and it's automatically done. So it's a great way of knowing I never forget my payment. Length of credit history, it's 15%. I mean, how long you have credit extended for you. Do you have credit extended only 1 month, or you have credit extended 20 years or 10 years? This is how long you've been extended credit. It's about 15%. Type of credit use. So there are two type of credit use. One is revolving credit, and one is a fixed credit. So a fixed credit is a loan. Let's say you have an auto loan, is a fixed credit, meaning that it's not revolving. It's just every month you pay the certain amount of payment right into the loan. So it's a 10,000 you pay every month out, say $200 to $300. Your payment is fixed every month until you pay off the loan. Remember, payoff is like when you're done, finish paying off the loan every month. Revolving credit is a credit like credit card. So you take some credit, you use it. Let's say you have a line of credit that is, and a credit card that is extended credit of $1,000. You can use the $1,000, but then if you maximize it, you can't use it anymore. But let's say you pay back $900. Now what you have a revolving, mean that you have a credit of $900 for you. So the credit, look at what is the mix. You have mortgage, you have personal loans, you have credit cards, you have fixed loans. What is the mix of loans that you have? And new credit, when was the last time you applied for credit? What's credit available for you? So this is some of the main factors that go into a credit, and all this calculated in the formula. And then when it's calculated, it's get out, the results is what is your credit score. This is a sample of a credit report. And you've seen a credit report, it will tell you here then the name, the report number, debt report, but it will tell you again your address. It will give information about if there's any negative information about you, but also it will, when you apply for credit, this will tell you credit item. Let's say bank A, B, C, D bank. You have a credit with them, and this is the account number. It's paid or past due. When it's open, when it's last reported, is it installment? Installment is the fixed loan, mean that you pay every month the same amount. What is the term? 12 months. Monthly payment 0. Is it individual responsible, or it's a two people? It's a co-signer on it. What is the original credit limit, loan amount, and recent balance 0. So each month an account history was 60 days late as this date, and it was 30 days as late as this date. So this is just a sample of a credit report. Each company has a different way of reporting it, but it will give you definitely all the information about you. It will say, it will give you Social Security, it will give all the credit. So this is how they collect the credit from all the financial institutions. They put in one report, and they will give you your credit report. So when you apply for a loan, we sent a request to look at your credit report, and the underwriter, the person that look at the loan, looks at all your information, make sure, first of all, there's no fraud, who is the person, the date of birth, what the employment, how much they pay, how they pay, and this how they make the determination, do they have any negative items on the credit or not, and this is how they determine what the loan amount to give you, and what rate to give you, so based upon your credit. So why good credit matters? We talked about the interest rate before, but the credit report score reflect important information about you, and will affect many events in your life. Housing, if you go to buy a mortgage or you go to rent, they will look at your credit. Transportation, if you buy auto loan, if you get an auto loan, you have to get the loan. Employment, some employees are looking at your credit. If you work in a financial institution, you work any high secret government job, or you're looking for working for any job that has involved money, likely that your employer will pull credit report about you to make sure that you don't have any issue with the credit. Utility services, electric bill, phone will ask for your credit. Insurance, when you apply for auto insurance, you ask for insurance. Entrepreneurship, when you want to open a business, they will look at your credit. If you take a loan, to see if you can take a business loan. And so there's a lot of things that are affected by your credit. So how do I build good credit? So why do people talk about really build good credit? First of all, the first step in which you took it today, and I think I want you to make sure that you expand your knowledge of it, is really understanding what is credit. Credit, again, it's not just the hour that I talk about, but truly, I would encourage you to read more, understand what is credit before you borrow any money. Do not sign anything unless you understand what you're signing for. Don't take anything unless you understand what you're signing for. Because I've seen many times when people went to college for years ago, they signed credit card, they got a T-shirt for signing for a credit card. They didn't understand that they need to pay it back. They had a party, they charged $3,000 on the credit card, didn't pay it back, and they ended up college with very bad credit, and it was very hard for them to restore back the credit. So you don't sign anything unless you understand it. And so this is a rule to, I think, for everything. You don't sign anything until you understand what you're signing for. Be responsible. Make sure you can pay credit this back. Make sure that you can pay your loans back. Don't take a loan if you cannot pay it back. If you don't pay it back, you take a loan, you cannot pay it back, you will ruin your credit. Charge only what you can afford to pay. Again, if you can afford it, don't do it, because again, if you cannot pay it back, don't do it. Pay all of your loans and credit card time on bills on time. And I talked about it before. You always want to make sure that you pay things on time. This is one of the most important things. Make sure you can afford it, you can pay it, and you can pay it on time. This is the way you establish your credit. Avoid going over credit limit on your credit card. If you have a credit card and the credit limit is $1,000 and you charge $1,200, you will have a problem in that you went over your credit. And so it will definitely affect your credit score. Know which account are shown on your credit report. You can ask the credit, as long as you're 18 years old, you can contact the credit bureaus and you can ask for a credit report. They have to supply with one free credit report a year. So you definitely want to make sure that you familiar yourself with your credit report, what is on the credit report. You may not have anything right now because you never apply for a loan. Unless you apply for a loan and you have anything that has to be triggered for credit or loan, you won't have any information in it. So once you apply, you will start having information. You said that you apply for a loan and it will get all the information from your credit application and will put it in the credit report. So when you do a credit application, you always want to make sure that the information that you put in your credit application is correct, because this is the information that will be recorded in your credit report. And so it's very important that when you apply for anything, you put correct information. And if you make sure that you put your correct Social Security, because all these things, if you don't have the right Social Security, and they will pull your Social Security in the credit report, it will flag it as a fraud. So you need to make sure always you put your information there, and also check your credit report to see that all your information there is correct. And again, request of credit report at least once a year, review it. It's free, you don't have to pay for it. Check that information shown in your report is accurate. It's very, very important. And there's no fraud, no someone else took your credit, stole your credit, and opened accounts in your name. And create a budget. So next week, we want to talk about creating a budget that will incorporate loans, incorporate, in the deposit account, how to manage your money. But it's important that it will fit within your budget, because it doesn't fit within your budget and you don't have a budget. Usually people don't have a budget. There's a big correlation to what their credit look like, mean that you have to create a budget, know how much you can have, how much you can pay, and to make sure. So those are free credit reports. Those are the information about the credit reports. They have Equifax, Experience, and TransUnion. If you, there are a lot of information, free information, that Equifax, Experience, and TransUnion provide. If you go to their website, there's trove of information. You can read about it, great information, and it will help you to really understand more in credit. This is an hour about credit, but I will encourage you to go to this website and really learn more about credit and what are your rights as a consumer and how do you establish great credit. So this is all I have about credit. What is credit? And there are different ways to establish credit. Of course, you're going to have to take a loan. They depend on the institution. When you get 18, you can actually sign for a loan. Before this, you cannot sign. It's not legal age. You can sign for a loan. So some people have different ways of establishing credit. Some young adults, their parents put them on their credit card, and they receive some credit from the parents' credit. Sometimes you apply and you have to have a co-signer. So let's say my son will apply for a credit card and he doesn't have any income. He will have probably the bank or the credit card company will ask for me to co-sign for him to make sure that they guarantee the loan. But what happens is when you have it, and let's say my son doesn't miss his payment, it will reflect on my credit as well. So you have to be very careful about it. And yeah, people have to understand what is credit. There are different ways to do. We offer a credit starter program. We actually create a secure loan for you for an 18 years old where you can establish credit and saving at the same time. It's a 0% loan and help you to establish credit. There are different credit cards. There are different financial institutions offer different product to people to establish credit. What I recommend is to do your research, to look at the information and to make what best fits for you. So this is what I have so far. I don't know if any questions. I know we're running out of time, so I just want to make sure that I answer some questions. Rachel?
Okay, so let me screw here. The first one was, how hard is it to get perfect credit?
Well, it takes time. It takes time. It's not that you take a loan. Some people think that they take a loan for $1,000 and they pay back the loan in a month, $1,000, and they have great credit. It takes long time to establish good credit because they look at if you remember in my presentation, and I go back a little bit here to this, it'll take to really get good credit. You have to make sure that you all this information is met. I mean that credit history, you pay for a long time for your loan, for your loans. You take loans, you're responsible, you pay for it. What is your credit? How much credit you have? How much credit you use? The usage of credit is important because if you use more than 30% of what the credit extended to you, your credit credit score will go down. It will take a couple of years to really establish good credit, but you have to start someplace. So definitely it takes some years, but if you don't start, you will never get there. It's a lot of patience, but a lot of make sure that you pay and you're responsible and you understand what you're signing for and you have a strategy how to build your credit. It's not going to be in 2 months you have 800 credit.
And then there was one more question, which was, what would be the credit score for a young person with one credit card to start?
It's very depend how, again, it depends. There's not, if you have nothing, you have zero. Okay. If you have no loans or you have nothing, you have zero. If you have credit card, depend upon what is the length of the credit card, how long you pay, what is the payment. It's no way for me to know, what will be. There's no rule that say if you have one credit card, you have 700 or 600. It depends how long you have the credit card, what is the payment, what is the length of the amount that you pay, how much you pay minimum payment or not minimum payment. So there's a lot of factors that go into it. There's no rule that say if you have a credit card, you have 600. There's no, it's, as I say, it will take time to establish good credit.
Thank you. And that was it, I think, for questions. Does anyone? Oh, let me check the Q&A here. Okay. Do debit cards play a part in the credit score?
No, because debit card, it's a good question. As I mentioned before, debit card is tied to your checking account. If you don't have money, let's say your checking account is $100 in it, and you don't have money in, and you charge $200, your debit card will decline. But it's not reported to the credit bureau because it's tied to how much money you have in your checking account. So, however, let me tell you this: if you have a checking account, okay, and let's say you overcharge or your checking account, you withdraw a checking account, and let's say some some financial institutions do have what's called courtesy pay. So let's say you charge $100 and you go over it, the institution will say we'll give you extra $30 to make sure that you pay the transaction, but you have to pay it. There are fees that tie to it, overdraft fees, and you decided not to pay for it, and it goes to collection, and after it you don't want to pay back the money and we have to close your checking account, it will report as a negative collection to your credit bureau. So definitely have some effect, but the debit card itself, it's not tied to the credit bureau, only credit card.
Thank you. And it looks like there's one more question.
Of course.
Is credit different compared to debit or any other type of payment or account? I guess it's kind of similar, but
It's very the same. I mean, again, debit, you don't have payment on debit card. Debit card is like electronic check. If you don't have money in your checking account, you can't use the debit, right? I mean, if you go to use the debit card in a point of sale, let's say in a supermarket, and you only have $100 in in your checking account, and your bill comes to $105, and you swipe your debit card, the transaction most likely will decline because you don't have enough money in your debit card. So debit card is really like cash. I mean, you can go to the store and give them $100 and it will cost you 105, right? So debit card represents what you have in your checking account. A credit card is, in a way, it's a loan. It's extend you a loan. Let's say you have a credit limit of $1,000. So today you go to the store, and the bill is $200. You swipe it, it will approve. And but what happened? You will receive a bill from the credit union on the bank that said that your usage, you use $200, you owe us $200, and your minimum payment is going to be, I don't know, $20-$30. You have to pay it, but the balance is $200. So I mean that you have a loan. Credit card is a loan. When you use it, you take a loan. It's an agreement. This is why when I say about reading everything, it's very important. You know, a lot of people go to different department stores and they've been sold credit card. And this is one of the big pitfalls of people having bad credit. They get the credit card at a department store because they think that they're going to get a 10% discount. And they don't read all the information about the credit card. The person that works at the cash register doesn't understand much about credit card. If you ask them what is the rate about the credit, what is the terms, they probably wouldn't know about it. So their job is to sell you a credit card. And so you get the credit card, you buy a shirt, costs you, I don't know, $20, you get the $10, $10 or whatever they give you for getting sign up the credit card. And then you get a bill and you don't pay this bill, you already ruin your credit. And what happened, you will have a lot of fees, you will have a lot of late payment if you don't pay for it, and you will ruin your credit. So I will caution you, don't sign anything that you don't know. If someone tried to sell you credit, first of all, you need to make sure that these people really understand what they're trying to give you. What you ask them, what are the rates? What are the terms? What are the late fees? What all this information. And so don't sign for anything unless you know it. And this is a big mistake that a lot of people do. They sign for it, have no idea what they signed for, just the thing to get the 10% discount, and they cost them hundreds and hundreds of dollars and ruin their credit later time. So I will say, cautious you, you have to be responsible. You have to sign anything you sign. You need to know, understand what, and you have to do it on the spot. There's no such thing on the spot. You want to read it, sign it, you have to understand. I mean, of course, if someone sit and explain to you what is the product, what is the rate, what the risk, you have to ask them what the risk, what the rewards for it, how does it help me to build my credit, and so forth. I think it's important because then it will help give you idea, but don't do something very rushed because it can really ruin your credit for years to come. It takes many years to fix credit. So
Yeah.
I will encourage you
There are
to read
two
everything.
more questions.
Uh-huh.
If a teenager gets a credit card under her parents, does that help her build her own credit?
So what happened is if you're just a signer under the credit card, you're not on the credit bureau, it won't help you because they can issue if you're 18, they can issue you a car under your name. But let's say I issue my kids a car under my name, they still use my card, but they're not responsible for it because they're not really on the credit. So they're not on this card. They can use the card, they're authorized user, but they're not authorized, mean they're not on the loan itself. They're not responsible for the loan. So they just have a credit card and they authorize you. I mean the main person that the credit for is the person. The only way to do a credit card is if you sign for a credit card and your parents co-sign for you, then you on their credit, then you establish a loan and you own a credit, and your parents be a co-signer for you. But if you just a authorized sign, I mean, you just use the credit. It doesn't give you a credit. It doesn't give you a credit. It wouldn't appear even on your credit.
And then the last question is, what about Venmo and PayPal?
They just payment services. So they just uh, transfer money from person to person. It's not credit. When you transfer money, it's like I'm giving you $100 and you give me $100. You don't give me a loan. If it's a loan to PayPal, I know PayPal have some loan services. If it's a loan, of course you have to pay back the loan. But if it's just you transfer money between people, it's not credit. Unless you have the credit card. PayPal has a credit card. You apply for the credit card and you use it, you have to pay it. But just a regular payment, Venmo and all, it's not reported to the credit bureau.
Thank you so much for
Yep.
all your expertise and sharing your knowledge.
Of
We
course.
hope to see you all next week. We are having our final session next Wednesday, the 28th at 2 p.m. And go ahead and fill out the survey and have a great day. Thank you so much.
Yeah, thank you so much. Thank you. Thank you, Rachel. Thank you,
Bye.
everyone. Thank you.
Have a good one.